Good morning from Los Angeles. Welcome to Trading with Sergio Monday edition. How is it going? Hope everybody's weekend was excellent, as was mine. Back at work, back at the grind. A lot of things, actually, market's not doing much, but underlying equities are moving quite a lot, actually. A couple of the names that I'm involved in, on a positive note, actually. So welcome to Trading with Sergio, Monday edition. It's 10 a.m. Pacific, 1 p.m. Eastern. So the schedule for the newbies on the channel is Monday and Wednesday. I'm going to do Trading with Sergio Monday and Wednesday editions. Friday Power Hour, go through a couple of topics, and then move on. I was absent from my chat this morning. I had other obligations, but then I posted a couple of new trades that I entered, which I will share with you as well. Yeah, I'm sitting on like 80%, 85% cash. Not liking the market, what it's doing, but also it's just there's no downside. I mean, there's limited downside and limited upside at the moment, it looks like. But again, when you're trading, you don't trade the stock market, right? You trade equities, different things. So if the underlying is working for you, then yeah, that's what we're going to look at. As far as news, we know what's happening with the peace talks at the White House now with Ukraine president and European leaders. President Trump had a show of force with Putin. He had that B-52 and a couple of F-22s fly over his head. It looked like Putin was pretty impressed. And I like what President Trump is doing when it comes to the world affairs. He has, it seems like in everything else, he has his hands on. In fact, I was very pleased to see a long-standing conflict between Azerbaijan and Armenia. As you may know, some of you know, I'm Armenian. Wasn't born in Armenia, but it's my country. It's free for me to go and visit, obviously, and it's an independent country. It used to be part of the Soviet bloc. When the Soviet bloc broke up, Armenia became its own country. There was a peace treaty signed between Azerbaijan and Armenia, and it happened under President Trump a couple of days ago. And I was very pleased to see that. Enough bloodshed around the world, folks. War is not going to get us anywhere, right? Peace is prosperity. And I like what he's doing when it comes to foreign policy, to be honest with you guys. I'm not agreeing with everything they're doing, specifically on the fiscal and the monetary end, but, there's no perfection on this planet. And if he can put an end to this extremely bloody long war between Ukraine and Russia, I think that will be the feather in his cap when it comes to foreign policy for his remaining, 3.5 years of presidency. And I'm hoping that President Zelensky doesn't behave like he did last time. Let the cooler heads prevail, and we'll have peace. Look, all these things are difficult things to do. Everybody has their point of view, obviously, but I'll take peace over war any day. What else is going on? Well, I'm putting out a video today at noon. Please go check it out. Our national debt hit $37 trillion with a T. But today I'm want to talk a little bit, a couple of topics I want to talk about before I share the new positions I put on, and some I'm trying to trim and trimmed already or closed already, is when we have all this debt outstanding, right? Somebody's holding the bag. It literally is the bag. I will explain that in the next couple of topics I'm going to talk about. The other thing I want to do is I have some time today. I'll probably go until 11. So if any of you want to join, I will put out the link after I do the topics. Grab it and come on down. Whatever you guys want to talk about, we'll talk about. So let's start with who is holding the bag? Well, when we have 37 trillion in national debt, that means borrowed money. That means IOUs that we put out. The reason for that is we have a $28 trillion GDP, gross domestic product economy. Okay. Out of that, the Treasury receives income taxes, capital gains taxes, Social Security taxes, all that stuff. Just like we have a budget, we have a W-2, we get a paycheck, right? So we know what's incoming. And we also know what's outgoing because that's our spending. It's the same thing in the trillions when it comes to the federal government. So the federal government has approximately about 5 trillion coming in. Okay. Let's figure out it's a pipe of 2 inches thick. Okay. That's the incoming revenue. Again, it's from capital gains taxes, Social Security taxes, income taxes, obviously, corporate and individual basis. And then we create a budget, and it gets approved by the legislative branch, which is the House and the Senate. And then it goes to the president for his signature, which he did with the big, beautiful bill they passed. Well, the spending on the big, beautiful bill was above 7 trillion. So if we're only bringing in 5 trillion and spending 7+ trillion, we have a budget deficit. That budget deficit has to get closed somehow. Well, how does that get closed? We issue IOUs. We borrow money from the rest of the world. So there's a 2-inch pipe that's coming in, figure out, okay, and then there's a 3-inch pipe that's going out. Well, when we do that, whatever is coming in is never going to be enough. So we go issue from short term, from weekly treasury bills, monthly treasury bills, 1 year, 2 year, 5 year, 10 year, 20 year, and 30 year. So the longer you go, the vernacular changes. They're called bonds. Anything over 20 years is called bonds. Anything less than 10 years is called notes. And anything less than a year is called bills. Well, we have to issue these. As I explained, if you have 2 trillion or 2.5 trillion budget deficit, the money has to come in and the budget has to get balanced somehow. Well, it gets balanced by borrowing. And when I said who's holding the bag, second topic I'm going to talk about today is about the US dollar, how weak it is, and the ramifications of a weak US dollar. So when these folks from the globe, US, anywhere, sovereign wealth funds, they all come and buy these notes and bonds and bills from the US Treasury. When they're issued every day, billions of dollars auctions are held. We don't hear much about it because it's done in a seamless fashion. The reason for that is not only we have to issue new debt to make up for that new 2 to 2.5 trillion in deficits, we have all these notes, bills, bonds we have issued over the last decades. So, for example, if you bought a 30-year bond from the U.S. government, right, the U.S. government has to pay interest on that. But, for example, if you bought it 30 years ago and today is your expiration, the U.S. government has to give you that money back, has to pay you that back. It's called maturity. So the bonds are maturing. And those bonds also have to get replaced because we have no other way. We can't just say, we're not going to pay you back. We're not going to default on our debt, obviously. So what the U.S. government does, not only the new issuance is coming around, you guys understand the mechanics of this, but the old bonds, notes, bills that are expiring have to be replaced by issuance as well. So what that does is that creates a lot of supply, okay? So when there is that much supply created, what happens? Demand may slacken, or the buyers of these bonds, notes, bills may require a better return. And that's what's happening. The interest rates on the new issuance is pretty high compared to what we're replacing it with. So 30 years ago, maybe that bond was sold at a 3% coupon. It's called a coupon, the interest rate. And today it's going to be at 5. So what happens when we issue it at 5? We issue it at 5 to satisfy the buyers of these, but then our interest servicing costs are going higher. Okay, so when I say who's holding the bag, it's proper. Who is holding the bag? Let's talk a little bit about that. So foreigners own more U.S. stocks and debt than ever. Investors from overseas now own 18 trillion of the U.S. equity market. They also hold 15 trillion in U.S. debt securities. Let me repeat that again. Investors are from foreign overseas entities now own 18 trillion of U.S. equities, and they hold 15 trillion in U.S. debt securities, which are the bonds, notes, and bills. They own 20% of the total equity market and 30% of the treasury and corporate credit markets. This is into the trillions, folks. Do you guys see what's happening to this chart underneath? You guys see how that line just keeps going from the lower left to the upper right? Well, there are reasons for that. The reason for that is the foreign entities, the foreigners, have to kind of buy that. The reason for that is that the US dollar is still the reserve currency on the planet. Almost every trade, every transaction is done in US dollars, and they need those US dollars, so they buy those bonds, notes, bills, and stocks. And we know what's been going on in the US stock market over the last 3 years since the bear market ended in 2022. Well, there you go. The foreigners are holding the debt. Now, when and if we get a sell-off, will they be forced to liquidate, or are they going to hold? Right? Because all this money coming in, that's one of the reasons, by the way, the stock market, gold market, Bitcoin, Ethereum, all these hard assets, real estate are at all-time highs because there's constantly money coming in. The only problem that I see with that is what happens on a sell-off. Will they be forced to sell? If they're leveraged, absolutely. And some of them are. But when I say who's holding the bag, the foreigners are holding the biggest bag. But because the US dollar is the reserve currency of the planet, we're easily satisfying that demand, with the exception that our interest costs on this borrowing is gone through the roof, out of control. I'll talk more about that on Wednesday with the fresh numbers. As of this year, the interest cost only, just the interest cost, is going to be $1.2 trillion. Now, can we take that 1.2 trillion and use it properly in this country? Of course, but the only way that's going to happen is put our fiscal house in order so the monetary policy can follow a proper fiscal policy, which is a balanced budget. If we don't have a balanced budget, and for the foreseeable future, as far as the eye can see, I don't see one, we're going to have to borrow. And when we borrow, see, what happens is that we're putting more and more of our future in foreigners' hands. Now, what could they do? They could come and sell these bonds, because you don't have to hold this to maturity. You can sell it anytime you want. What if they came and sold those bonds? Now, that's going to create more supply on top of the supply that we're putting out to cover those deficits. Well, interest rates will shoot up. And that's why I talk quite often about the Federal Reserve not having any control over the interest rate market. Yes, President Trump and the administration is yelling at Powell, saying, cut the rates, cut the rates, cut the rates. Well, we can cut the rates all we want. We have cut the rates, 100 basis points. But since then, the global bond market and the U.S. Treasury bond market has gone the other direction. Because what is happening is that the Chinese are selling U.S. Treasuries. Japanese are selling U.S. Treasuries. Actually, Japanese are the largest holders, and right behind the EU and UK, and China used to be number one. They're down to number 3 now. Well, they still hold billions, trillions of dollars worth of notes and bonds. Well, they can come sell those. When they sell those, it creates additional supply. It could spike interest rates up. When interest rates spike, so basically we have our destiny in their hands by issuing all these notes, bonds, and bills. Is it a good thing? Of course not. Why should they be controlling our future? But if you live by borrowing and spending, there is no other choice. Who else is going to buy those bonds, right? Now, the Treasury themselves buy those bonds, believe it or not. What they do is they print money on one side and they come and buy these bonds to support the market. It's a racket. I understand it. Basically, you're getting high on your own stuff, but look, the system is so large these days into these trillions and trillions of dollars that we have to do this. We cannot stop the musical chairs at this point. Because every time we have a crisis, when we had crisis in 2008, it only cost the taxpayers $800 billion. It's called TARP, Toxic Asset Repurchase Program, to clean that mess up. Well, that mess got cleaned up, and then COVID showed up. During COVID, it was a black swan event. Nobody was expecting it. And then we had to pump in $7 trillion into the economy. That's why these deficits keep going higher. And when we do pump it, okay, and every 12, 15 years, there's some sort of black swan event that takes place. Okay, how much do we need to spend on the next black swan event? Well, how much can we do that? Is it going to be 15 trillion, 20 trillion? Now you guys understand the correlation between all this money getting printed and pushed into the system and why these asset classes like the stock market, gold and Bitcoin and Ethereum now, real estate, all these asset classes, hard asset classes, keep going higher and higher and higher because all this money is pushed into the system, and that money has to look for return, and then it goes into it. And that's what the foreigners are doing as well. Foreigners owning this much of our future is not funny and it's not good for anyone, but then we're in a box. We have to do what we have to do. So yeah, I hope I was able to explain this to you guys because it's an important issue. Who's holding the bag? All right. Good morning, Traveler. Good morning, Luis. SJ, good morning. DJK. Fed only controls short-term rates. Exactly correct. So the Fed, can control the Fed funds rate, and that's about it. And I mean, the projections are there are going to be 3 cuts this year, 2 or 3, 2 minimum. The other thing is every asset class is at an all-time high. Is it proper to cut rates? I mean, last week we had a PPI number, which was extremely hot. And what's going to happen to inflation if they cut the rates at this stage? I don't know. I don't think it should be cut. Rates should be cut. But then the reason they're looking for lower rates is that we have close to $9 trillion of bonds and notes and bills maturing this year, the rest of the year, in the next 5-6 months. Those have to get replaced. Well, when we first issued them 5, 6, 7, 10, 15, 20 years ago, the rates were a lot lower because we had something called ZIRP, zero interest rate policy. Well, now we have to replace them with today's rates. So the reason administration is asking for rate cuts is for the U.S. government's interest rate costs to come down, as opposed to the consumer auto loans, car loans, and mortgages to come down. And I mean, they will come down slowly because banks raise these rates real quickly and then cut them slowly. But he's correct, DJK, right? They can control the Fed funds rate, which actually they have cut the Fed funds rate to 4. But what has happened? The bond market, global bond market, which is into the trillions, and this is not just treasuries, by the way. This is corporates. This is, municipal bonds, obviously locally, but there's so much debt around the world sloshing around that we have to issue more debt to just cover them when they mature. And it's basically kicking the can down the road. And since the Fed has cut the rates 100 basis points, starting last September, the 10-year and 20-year and 30-year treasuries on the long end have gone up 100 basis points, quite the opposite of what the Fed is trying to do. So, I mean, I'm sure Scott Bessent and the administration are brilliant people, but they have to understand that what they're going to do, cutting the rates or telling the Fed to cut the rates, doesn't work. The bond market is its own animal. It has its own thing. It's not going to listen to the Fed or the administration. Now, one thing administration is doing is that when these longer-term bonds mature, they're going to a lot more short-term borrowing, okay? They're going to bills and 2-year notes and things like that. I understand, but then now you're squeezing yourself in time, right? You have, what if we have some sort of event that we have to move the rates quickly, right? What's going to happen? So we're in a box. I mean, look, if you lived on borrowed money, this will catch up. When will it catch up? I don't know. How will it affect the stock market? I don't know. For me, it's short term. I trade what I see, what's in front of me, and then the rest is the rest. So one more quick topic, and then I'll answer questions, go to positions. Is the US dollar trash? I believe it is. Maybe you guys put it in the chat if you guys believe it is as well. So I've spoken about this quite often. We all have $100 bill in our pocket, I'm pretty sure. And we look at it. What does it say? It says 100. It said 100 5 years ago. It said 100 10 years ago. That's called a nominal value, 100. Okay? But is it really worth 100? Think about this. Just because it says 100 on the bill, is it still worth 100? No. Why is that? Is because, again, goes back to our borrowing and spending habits. Every time we do that, we supply more dollars into the market. In order to supply more dollars, we don't print on paper anymore. We just add zeros to the ledger to create more money out of thin air. Well, when you create so much of something, just like everything else I said before, and then maybe people just go like, that's not that simple. It is that simple. It's supply and demand. How much supply are we providing? How much supply of dollars are we providing to the marketplace? Into the trillions. Well, just in the deficit alone, $3 trillion. Okay. If we're supplying so many dollars, what happens to the value, the actual value, the notional value of that $100? It loses its value, right? Because we have a lot more of something. When you have a lot more of something, the value of that something, it could be tomatoes, potatoes, and lettuce, whatever it is, eggs, or currency goes down. Well, it's a fact that's been going on. Just this year alone, US dollar has lost close to 11% of its value against a basket of other currencies, okay? Such as the yen, such as the euro. Well, remember that $100 bill that you're looking at? Okay. Well, that $100 bill is losing, it's called debasing of the currency. It's losing 6-7% on average for the last 5-10 years. So let's take that 6%. Let's make it simple. Multiply it times the last 5 years, times 5. That's 30%. So that $100 bill that you're looking at that still says 100 and it said 100 5 years ago, now it's only worth $70. And you can experience this yourself when you go shopping. With $100 5 years ago, you could have gone out and bought a bunch of stuff. If you have that basket in your mind, why don't you just go take the $100 today and go spend the same $100 on the same goods you purchased 5 years ago? On the internet, there are a lot of people who are doing these types of comparisons. That's another word for how much of that buying power are you losing per year? Well, it's about 6 or 7%. And as opposed to just yak about it, and here are the facts. These are the facts. And this is the US dollar chart on the right-hand side, how much value it's losing. The fiat currencies in general around the world are losing value because all governments are creating more fiat currency. When I say fiat currency, it's dollars and yen and yuan and euros and Australian dollars, Canadian dollars, whatever it is. So when fiat currencies are losing this much value, it's called a bear market, right? Bear market meaning your 100 is worth 70 in 5 years, it's going to be worth another $30 less. So no economy has maintained an average inflation rate below 2% since the end of the gold-backed Bretton Woods system in 71. As you guys can recall, we were on the gold standard, meaning we couldn't issue dollars unless we had gold backing those dollars up. And it was during the Nixon administration where they went away from the gold standard. When that happened, economy took off because borrowing became a lot simpler and cheaper for the government. Economy took off. Initially, actually, it was okay. But now that every dollar that we borrow returns about, ROI is about 46, 48 cents. Well, now we're like literally, we borrow a dollar, we're losing half of it. Okay. And that's your buying power loss as well. So In other words, the value of fiat currencies has fallen by at least 2% annually over the last 54 years. You guys see that chart? That's the chart of 54 years. So meaning what? Even if it's 2% and 54 years, 54 times 2 is 108. Literally, if you had a $100 bill, that same nominal $100 bill that you were looking at 54 years ago, and some of us old enough to know that, that currency actually is negative $8 now. It has lost all of its value, all of its buying power, just by 2% inflation, okay? For example, the US, Canada, China, and France have averaged around 4% inflation over this period. And I believe it's a lot higher because I know governments gaslight the folks in their countries. I think it's close to 6 or 7%. And you can feel that when you go shopping with that $100 bills. Meanwhile, Brazil, Argentina, and Venezuela have seen their currencies collapse by nearly 100%. Those are the hyperinflationary countries, right? Argentina's and Venezuela's and Brazil's. Imagine living in those countries. Basically, everything you buy this year is 100% more expensive next year because it's losing your fiat currency, local currency is losing 100% of its value. Imagine how difficult it would be to live in those countries, because I'm pretty sure nobody's paycheck in those countries, right, is going up 100% every single year. So in order for you to keep pace with all this, folks, your income has to go up by 5, 6, 7% a year just to keep pace with inflation. Inflation is gold and crypto's best friend. Absolutely. And that's why I keep saying what on this channel? I've been saying it from the first day on. Don't slave harder, save in our hard assets. Why are hard assets where they are? It's exactly because of that reason. Okay. So gold at 3,500, Bitcoin holding right about 118 range, Ethereum now taking off, doubled over the last couple of months, 3 months. Real estate all-time high. But what does that do? It makes housing affordability in the tank. Nobody can afford a house. A couple in their 30s, college educated, maybe their incomes are not enough for the down payment and afford a mortgage. Same thing is happening everywhere around the globe, except that we're the best one out of all the worst ones, supposedly. But then how's that affecting you? Is your paycheck going up 6, 7% a year? Is your employer paying you 6, 7% a year more every year? And you need to do that just to keep pace with inflation. And that's why I keep saying education is key, information is key. You have to invest. You have to invest in hard assets because they're the only saving grace. You can't keep money in a bank at 0.5% savings account or even put it in a CD at 3, 4%. You're still going to lose. It's better than nothing. You can put it in money market at 4%, but then you're still going to lose maybe 2, 3% of buying power. It's better than losing 6, 7, of course. But that's what I'm trying to say. All fiat currencies are in a bear market. All fiat currencies every year are losing value. Even if there is 2% inflation, okay, which I know it's not, we're losing value on that $100. So you have to invest, or you have to have a job that pays you 5, 6, 7% a year more every single year. Now, if you're working for somebody else, I don't think you're able to do that. But if you're an independent contractor, if you're a plumber, air conditioning, contractor, electrician, whatever you are, now you have a chance, especially if you own your business, you have a chance to increase those prices or increase the bids that you're offering to your customers. You have some sort of control. But if you're working for someone else, which 95% of the country works for someone else, I'm assuming it is 95%. It could be lower. I know small businesses are important for this country, and there are millions, hundreds of millions of small businesses. But then their pricing power is not there either, because what happens is that if you own a small business and increase your prices to the point that the demand dies, right? So there is a catch-22 in all of this, but the key is US dollar is losing its value. It's the prettiest girl in a very bad house, as we know, but that doesn't mean you're not losing money. You're losing value on your $100 bill constantly, and you have to invest. You have to invest properly, long-term investing, dollar cost average into hard assets, whatever you can put away. You have to, just to keep pace with all this. Now, if you can do 2x, 3x, 4x of the benchmarks like S&P 500 and things like that, then you're in great shape, right? It's difficult to do, but it's doable, and that's what I'm trying to do on this channel. So anyway, so I'm done with my stuff. So it's 10:30. We got half an hour. Let me put the link up if any of you want to come on. I'm not sure, but most of you are shy. You don't want to come on. And here's that. Here's the link. All right, Fed only. Okay, we read this comment. Fed only controls rates. Yes, that's correct. DJK, what's up? With a 2 trillion annual deficit, the government's only solution is to deflate. Yeah, exactly. That's the only way. Now, there are some talk that, they may do something about the deficit with stable coins. I don't know how that's going to work out. I'm looking into it. I don't really perfectly get it yet, but I'm going to study it. I mean, Scott Bessent is brilliant, but look, man, 37 trillion in debt is 37 trillion. We have to pay interest on that. Tom Cruise. Well, I'm sure you're not the actual Tom Cruise. With everything the Trump administration is doing, the rate cuts are going to soar this economy like we have never seen. I quite disagree, actually. Okay, I disagree with that. I voted for Trump, but I disagree with that completely. When you cut rates, force rate cuts, the market's not going to listen to any of that. None of that. And then the reason is, why are you cutting rates, right? If the economy is slowing down and you're cutting the rates for that, the markets are already extremely expensive. You're listening probably a little bit too much of talking points for what's coming out of Washington. That's economy 101. You have to understand why the rates are being cut. If the rates are being cut because they're seeing a slowdown going into the future, the deficits actually are going to get worse. Rate cuts are not going to soar the economy. In fact, rate cuts may not even have any effect. As I said, maybe you showed up late. Oh, I sold something. I don't know what I did. But rate cuts have, what the Fed does has no control over what the bond market is doing. So anyway, but that's my opinion. And then I'm pretty sure my channel is going to be around by next year. And then hopefully you can come back and we can debate it civilly, of course. All right, so let's go to the positions. Let's see what we bought or sold. We remove this puppy. No, we add this to the stage. Here we go. Hope you all can see this. What is happening? Oh, market's rallying a little bit, which is fine. All right, what do we sell? What do we buy? Let's go to our monitor. So I added a couple of positions. I was down to 3, then 5. Now let's see, 1, 2, 3, 4, 5, 6, 7 positions now, which is fine. What are we doing? Let's go. What do we sell? Oh, we sold some LAC. Okay, cool. All right. What's going on? I have 80 AEVA technologies. August 20 calls. What do we sell? What do we buy? Oh, we bought some calls on CWVX. Okay, sounds good. They're not filling me today. I'm putting 10 lots, couple thousand shares. They're doing like dicking around with me. They're doing like 100 shares here, 200 shares there. It's okay, whatever. We'll get there. And all right, so AV Technologies, 80 calls, September 19th expiration, $20 call. Stock is about 13.5, 13.40. I will hold those. The next one is a new position. I started putting a long covered strangle on BLSH, which is called bullish, which is a new issue that came out. It was priced, I think, 35 or 36. It went, I think, as high as 120. And I just started buying it. So I bought a couple hundred shares at 60. Cost was 60. Let's see, 63.80. And they immediately introduced options, which is very, very good for me when I'm doing covered strangles. And those options are absolutely juicy premiums. So covered strangle is you buy the underlying shares, you sell the out of the money calls, you sell the out of the money puts. So meaning you're telling the marketplace, okay, so what I did is I bought the 200 shares at 63.80. I sold September expiration because they don't have weeklies. I wish they did, but they don't. I sold the September 50 puts at a cost of 190, and I sold the September 75 calls at a cost of 438. So combined, it's almost $6.25. So what I'm telling the market is, okay, I will buy more. I'm willing to buy more, or a couple hundred at least shares more of BLSH bullish at 50 minus the premium. So 50 is the strike on the put minus the $6.50 or whatever I took in will put me at 43, let's say, or 43 and a half. Well, stock is 64. I don't mind buying BLSH at 43 and a half. Or I'm telling the market, now you can come have my shares at 75 plus the $6.50 premium, which will put me at 82. Well, stock is only 64, like I said. So that's 20 points higher from here. So that's a covered strangle. So I'm telling him I'll sell you the stock at 83. I'll buy more stock at 43. We're talking a $40 range for only 32 days, right? Yeah, I like this trade. I'm going to add to this trade on the way up or on the way down, but it was a starting point. The other thing that go through the positions, I'm long 31 now instead of 30. I'm long 30 CWVX, which is the 2X ETF of CoreWeave, which lockup expiration happened a couple of days ago. Stock went from 155 to 95, literally, or 98, whatever it was. It's bouncing a little bit, holding, but then I started buying September $15 calls on the 2X ETF of CRWV, which is CWVX. And so we'll keep buying some more of those. I think stocks oversold. I think everything is fine. We'll get a 10% pop. This is a 2X ETF. This will pop 20%. It will be a profitable position. Next one, I had a covered strangle, which both sides of the put and calls expired worthless on HIMZ, which is the 2X ETF of HIMS. Cost is $17.33. Stock is 16. You're going to say, well, Serge, you're losing money. Yeah, sometimes we do until we make money. So the 2X ETF is 16. Okay. But I took in 85 cents, which was all mine because they expired worthless. Okay. So now my cost is lowered by 85 cents from 17.35, let's say. So my cost is 16 and a half. Stock is 16. I'm down a half a point. Unfortunately, on this one, they don't have weekly options either, but I may do September covered strangle on this as well. I was looking at some of the prices. It's really, really juicy. So I'll look at that. Actually, I'll look at that now. Let's take a look at that now. So I could put on a covered strangle on that going out to September, which is 32. So stock is 16. I could sell. Let's go 3 wide from where the stock is. So I could sell a 13 put for September for about $1. And I could sell a 19 call, again, $3 away, for about $1.35. So that's $2.35, $2.30. Well, $2.30, that means I'm telling the market I already own shares at 17 or 16 and a half. I'm willing to sell these shares to you, that 1,000 shares, at 19 plus that 2.5, which will put me at 21 and a half. Or I'm telling the market I'm willing to buy another 1,000 shares at 13 minus the 2.5 at 10 and a half, which is something at 16 at the moment. So I may do that, covered strangle, or just give it a few days until it clears itself up. That's that position. I had again covered strangle on LAC. Lowered my cost basis. I had taken in 20 plus cents. I was short to 2.5 puts, long short to 3 calls. It expired. Both sides expired worthless. Collected some premium. Sold 1,000 shares this morning out of 8,000. Actually, sold another few hundred shares. It looks like I'm only long 1,655 shares. I'm going to liquidate this position. I'm going to trim it halfway, basically, and then because I'm replacing it with something else. And this trade turned out beautiful, thank God. There's a lot of my members followed me on this, I think. So on Lululemon, I had bought October 250 calls. Last 20, I was long 50. By the way, all this you guys can go check. Full transparency on this channel. Go to the community page and check the positions. I'm not saying I was this, I was that. The proof is there. I post my positions every Monday, Wednesday, Friday for the subscribers. And I finally closed that position. My cost was about 430 range, and they're at 6. Last 20 I sold today in the 5.5 to 575 range. So that worked out because they had gone down from 430 down to about 260. And now Lululemon should be looked at as a buy on pullbacks kind of a candidate. And the new position I'm opening is Pioneer Power Solution. I bought 1,000 shares at 366. I'm a buyer 1,000 shares every nickel down. It's about 367, 370, or every nickel up. And basically, if I were to sell 4,000 shares of LAC, which I have orders in at 95, 96, 97, trim that halfway, replace that with that still 85+% cash. I'm going to have to start looking at other positions, what to do with other positions, newer positions. There are a couple that I'm very interested in. So let's go look at quickly to the charts. Let's go to big charts. Then I'll answer questions and say goodbye. So this is HIMS. Let me get rid of this label. Well, it shows my cost, 1,000 shares of 17 and change. But then the cover strangle, right? So we're going into support. Now, when I said I'm willing buyer at 10.5 or more HIMS or seller at 21.5, well, 10.5 is somewhere down here, which is like back here is support. So I may do that. I may do a cover strangle there. And selling at 21.5, which is resistance into the 20 EMA, but then it's 32 days. 32 days in HIMS is forever. So I'll keep it as is. What else are we looking at? Let's go with the market. This is SPY. Just, no corrections, no nothing. There is a possible bearish divergence that we're working on, but you can't anticipate these things. Once it's in motion, then I'll trade it. It's just going sideways, folks, before it goes higher. It looks like there is a channel that I drew. We may revisit the upper, because we're literally smack dab in the middle of that channel. We may revisit that. The super upper band channel is like way higher than here, about 6,800 range. So that's that. Triple Q. Same thing, just kind of consolidating before it goes higher. It looks like to me TLT, which is the 20-year note inverse indicator. So TLT going down means interest rates actually going up. So if the government even, by the way, so here's the example. Tom Cruise, pay attention to this. Here we go, Tom Cruise. Here it is. You see this, the TLT was 101.64. That's September. That's when the Fed started cutting the rates, the Fed funds rate, right there. So what has happened to TLT since then? It has gone from 101.64 all the way down to 86. That means even with the Fed cutting the rates, interest rates actually has gone up 100 basis points. You see what's happening here? So if you think cutting interest rates is going to make that much of a difference, why don't you go buy TLT? We'll see how that goes, right? So, yeah, a lot of people are puzzled looking at this, but it makes complete sense to me, actually. What else are we looking at? People, let's look at Tesla. Tesla is actually broke out of the wedge, pull back. I will most likely trade TSLL on that as opposed to Tesla, which is the 2X ETF. I'm very interested in SoundHound. We traded it, broke out, now pulling back. Today's low is where I would get in, actually, if it gets back to 14 range, low 14s, 14.10, 14 range. I'm a buyer. This pullback earnings were fantastic, gapped up, did exactly what it's supposed to do. I like the company quite a bit. They're in AI systems for sound as opposed to videos and things like that. They're in a hot area. It's not a small company. It's like a $5 billion company. Me and my members, we were short Joby. Yeah, it's dog shit. That thing is going to die. I was 100% right on that. And you guys can see the labels anyway. I'm not even going to bother with the labels anymore. If Joby takes off 15.5, we're going to have a quick visit to 14. And, I mean, this thing was like ridiculous. If you're interested in those EV tolls, Flintstone flying cars and taxis, Archer is another one. Rocket Lab is one that my members are interested in. Actually, it came into support, stopped there. ASTS is another one. FYI, I will talk about the members group in a minute. Wonderful, wonderful group. They're up to like 40 people. You get a whole bunch of benefits if you do become a member. So if you want to support the channel, look, I don't do it for the money. It's $10 a month. $10 is not even a burger. You're getting my experience and my know-how and my live trading for $10. It's like, but I have to charge something. I should probably charge $100 a month, but or $1,000 a month, honestly. But pay it forward, do what you do, educate folks. If you build it, they will come. I'm going with that attitude, but it's definitely not for the $9.99 a month that it is. But you're getting tons of value out of it. ASTS looks like a decent chart. Lemonade is one of my favorite stocks. Beautiful, beautiful chart. Let's see. Unity Software. I am actually long the stock in my long-term port. I'm also long Nike. And I'm also long Google. And I'm long Kava. In fact, I just sold. Earnings were not that great. I sold 65 and 60 puts on Friday in my long-term cash secure puts. I want to buy more shares at 63 and 58. So that's why you sell the puts. What else? That's about it. I mean, this is the new positions I put in. There's no chart really. It's 3 days old. Bullish, 64. I think what was the high? 118 was the high. Yeah. So covered strangle is the right thing to do there because the premiums are so good, and I'm willing to buy more shares at 43. I'm willing to sell shares at 83. So whichever comes first, and none of it may come first, and then my shares, the premium will, just like it happened with LIC, just like it happened with HIMS, they will expire worthless. The body is pretty wide. My body is 50 and 75. We're talking 25-point body. What are the odds BLSH will end between 50 and 75 next 32 days? Pretty high. But if they take it away, they can have it. Make much of money. If it goes negative, you're obligated to buy it. You can do all kinds of things with it, but then I'm willing to pay. I'm willing to buy 40 at 43 and a half, another couple hundred shares, but once I add it, it'll be that. PPSI, that's the new shares I'm buying. I think it's 570. Great earnings, actually. I usually wait until earnings. Now it's giving me a chance to get in. I bought 1,000 shares. I'm going to try to buy 5,000 shares of this today. It's pretty illiquid today, but on Friday it was not. It traded 100 million shares, actually. They're power generating equipment and regulation company. The best one in the hydrogen space is BE. We're long that stock. That's gone. But I'm basically in the AI side. I'm looking at SoundHound very carefully. I will either buy the equity or do a synthetic on this. Synthetic meaning sell the put, buy the call. Maybe like sell the 15 put, buy the 15 call. We had the same position before the big break to the upside. I was short the 13 puts and long the 15 calls. Synthetic is just basically replacing purchasing the company or purchasing the shares. But I'm going to trade more shares anyway. Yeah, that's where we are. LAC, I'm trying to sell 4,000 shares. We'll see. If I no rush today, tomorrow, whatever. I have an order at 95. I sold at 96 and a half. I have an order of 7 and 8, so I'll sell 4,000 shares by PPSI. Not that I need the money or sell it to do it, but I don't like to deal with like these little low price stocks too much, But I do like PPSI quite a bit, and it's optionable as well, so I may do a covered strangle on that as well. But a lot of other things I'm watching. I'm patient. I let them come to me as opposed to rush and do something with it. Patience, folks. 3 P's. Patience, position, and planning. All right, so I'll enter some questions. No questions, and nobody wants to come on? No? Okay. You guys be that way. All right. I'm out. I got nothing else to say. I showed the positions, answered the questions, talked about my couple of topics. I'll be back. So here's the schedule. Monday, trading with Sergio. Wednesday, trading with Sergio. Friday, power hour. On the other side, on Wednesdays as well, I have a members live. So if you do become a member, you get that. You get a live stream just for members only. and those are pretty cool. It's more one-on-one interaction, and you also will get the Telegram chat group link that I've established where all the trades go live. When I do trade, none of it trading or investing or financial advice, but I do post them live. And what I do is risky, so I would highly recommend have your own due diligence before you commit to anything, because I am not responsible for your losses, and I do take plenty of losses. But to me, ultimately, account equity is what matters. You know, if you can 3, 4, 5x the benchmark, that's what I'm shooting for in the trading account. Investment account is completely different. I'm trying to buy and hold in that account. But yeah, members get that. Members get at the end of each day, members get my positions posted, and they get the live transactions posted. It's a wonderful group. You know, we go do a lot of back and forth. They give me ideas. I give them ideas. Yeah, that's where we are. So with that, I'm going to say goodbye to you all. Hope you stay safe and make some money this week.